Hey everybody, this is Paul doing a quick video, just an update, kind of going over some data, just different things going on in the market, just some thoughts on December going into 2023. And as it currently stands, it is about 10 a.m. Central Standard Time on the 30th, last day of the month here. And this is where the market's at currently. As you can see, just kind of moving around. And that's what rates are doing right now. Rates are kind of up right now because Jerome Powell's supposed to speak at about 1:30 or so, so everybody's expecting him to do kind of the similar thing that he did before, where he's like, well, we don't like it when the market's this high, and we're definitely not going to cut in 2023. Like we're gonna, the bond market has it wrong. Um, so I guess let's just kind of go over where we're at, I guess, right now. Of the theme, I guess, of this video, a lot of my videos lately, I wish they were more positive, have been a gradual slowdown, not a crash. It's still some people like throwing out 2008 as we're going to see just some big 50% crash or something like that. I just don't think that's how this is going to go. You're just going to continue to see this gradual slowdown, slowing of the data. So where are we at right now? Like, why is the market this high? So as I stated before, Q3 earnings were the floor. Black Friday sales coming in strong continue to be the floor underneath this market that's keeping it up. But the problem is earnings need to go up. That's how the market goes up. That's just how this works. Um, you know, when you're at these level of rates, you need to post higher earnings, and that's how your stock price goes up. That's how the market goes up. So what's going on right now is it's a very technical market, as you can clearly see. Whenever we touch the 200-day moving average, ever since we entered 2022 here, that's the 200-day moving average. As soon as we touch that, we typically bounce right off of it, and we start to head back down. So this has kind of been your predictor of the bear market, like bear market rallies, or like, well, I guess bear market rallies, and then also the when a sell-off is coming to let you know. So there's number one, number two, there's probably number three right here. We got a few of these. Number four definitely. I think we're in number five. Yeah, it looks like we're in number five still. But it's kind of everybody's kind of expecting this one to go down. Possibly into 2023. It really depends on what the Federal Reserve does. It does not sound like they see the writing on the wall. So it sounds like they're going to try and talk this market down to something in here. So that was the entire idea behind, getting rid of this high interest card I had up here, and then working on this debt and whatever. That's literally what that last video was about. So that's why I took profits, obviously. So this is where the portfolio is at currently. And I might end up putting this number right here on the video. I don't know. We'll have to kind of see. This number is going to bounce around as the market kind of prepares for the Fed. So, like I said, the theme of the day, or the theme of the video, is going to be kind of slowing down. Everything's kind of slowing down. So this is just the market tracking the 2-year government yield, as you can see here. As the yield goes down, market goes up. As the yield goes up, market goes down. So I believe Powell's going to try and talk this number up. And here's some more data. So this is job openings, JOLTS. There's a lot of duplicate jobs in here. JOLTS hasn't exactly been the most accurate thing that's ever existed, but as you can clearly see, we have this huge demand spike. This is all coming off now. The problem is if this goes out faster than what it went up, or if this kind of just has a real big drop all of a sudden, is like just job openings just closed across the country, that's kind of a major problem. So here's the layoffs. As you can see, technology is making up a very large section of that. The Twitter layoffs, just across the board. NASDAQ really can't catch a break. Even DoorDash announced in their corporate side that they were laying off. Nothing affecting drivers yet. But the drivers have noticed a slowdown. I do DoorDash on a side. That's literally what this little tab is over here. I do DoorDash on the side, as you can see here. I've noticed a slowdown. There's a multitude of factors affecting specifically DoorDash, specifically like end of year taxes that people have to pay, which is effectively another mortgage payment you have to pay if you're a homeowner. When you're paying it to the city and the state, or not the city and the state, but the city and the county or parish if you're in Louisiana. You have Black Friday and Cyber Monday lining up, which drains people's wallets. You have the normal people got to pay rent, they got to pay bills, this stuff right here, right? Sell water, gas, internet, everybody else has that. It's just a bunch of factors lining up all at the same time. So there's been like a slight slowdown. Majority of the job cuts, except for specifically at Twitter, has been on corporate type jobs so far. Um, so where's so this is just kind of where they're at: warehousing, industrial jobs, industrial PMIs continue to come in just horrible, just absolutely horrible. Whatever supply gut used to exist in this country is guaranteed. It's just done. It's dead. That's right up there with housing on just how bad it is right now. So as you can see, not too many, not any really jobs in leisure. As you can see, like nothing really. We're still seeing actual growth in that sector. But obviously the big sectors that are getting hit compared to like say the COVID types of layoffs, you can see leisure took the biggest hit during the COVID layoffs, obviously. So so this is also the chart that I did. I've been trying to keep track of this chart, keep up with it. As you can continue to see, rents, the Zillow rent index is, and this, so blue line is what the Federal Reserve uses. This is a really stupid, really lagged indicator that they use. This one's just tracking the Zillow one. I guarantee you if you laid over the other ones, it shows this exact just massive drop. So 2023, you're just going to see, once this data starts to catch up, the CPI number should start to drop dramatically quick. Just dramatically quick. Going into 2023. So that's kind of why the market is not going to believe Powell today. Powell can come out and say whatever he wants. He can say, we don't like the market this high, and we're going to keep rates high until 2024. This is what the market is seeing. They know that this is coming. The problem is if you're dealing with the slowdown in the economy, which is very clearly happening. This is the volatility index, which is very low volatility right now. Very, very low volatility. As you can see, very low right here. People are expecting this number to spike up at the beginning of the year, starting next month. But so this is what the market is seeing. So Powell can come out and say whatever he feels like saying, but as you can see, if this number starts to fall through zero, which is entirely possible, which means you start to get negative rents. Now that's very bad because that means there's a lot of apartment openings, but there's also a lot of people not in those apartments. So where are those people? They're on the street, or they're getting roommates, that type of thing, or they're moving back in with their parents. So like I said, I expect Gen Z and millennials to yet again to take it on the chin in this recession, like we always do. So we have to kind of see what's going to go on here. But if you have, that's why I think the market is starting to call the Fed's bluff. If you notice, every Fed member's like, we're not cutting at all in 2023. The market is very clearly priced for cuts in 2023 because they see this coming. For some reason, the Federal Reserve is pretending like they don't see this coming. They act like if they acknowledge that this is happening, that this line is just going to automatically go all the way back up to here. That's not happening. It's just not how that works. The money supply just isn't there. There's just not government stimulus like there used to be. People just couldn't afford the rent, so the rents, it's just all rolling over completely in a very dramatic way. Housing, it's just taking it on the chin really hard right now. So how am I positioned right now? As it stands right now, so very clearly, as I showed you before on the chart, right there, you can see, I believe we're in a bear market rally. I don't see anything that has convinced me we're not in a bear market rally. Rates are still high. They're going higher, it seems, as the Fed tries to keep them high and keeps talking tough. Powell's literally going to come out today and try and kill this entire rally right here. That's I think that's his entire mission today. You gotta have to listen to the speech at 1:30, but I'm pretty sure without a doubt he's gonna try and kill this rally. So where do we go? Do we go lower than we did in June? Not without a recession. You still have third quarter and fourth quarter numbers that came in. Fourth quarter numbers I think are going to come in pretty good. If you looked around, Black Friday shopping was still massively high. So I think that slowdown where we could potentially break lower than the June lows right here, the August lows, would be 2023. The beginning of the year from January to March is just a historically weak period in the market. So we just kind of have to get to there. And if we don't break below those lows, then there you go. That's your bottom right there. That's your double bottom that you're looking for. And that's kind of, but it's really, it all depends on the Fed. When the Fed has to face reality of just like the amount of slowdown that they're causing in this market right now. So as it stands right now, because I expect a bear market rally that's going to roll over, which is rolling over currently, um, and the Fed's going to try and make it roll over, you can kind of see I'm starting to build up a cash position again now that I'm past taxes, past all the stuff and all the bills. I got everything sorted however I want to get it sorted. And yeah, so that's where we're at right now. So I believe, just going into December, we're probably going to see a lot of profit taking. Probably, if I had to guess if this is just a guess on how it's been going so far, between December 1st and maybe December 15th, we're probably going to see a sell-off. And then when we get the CPI report, which I believe is mid-December, and then we get the federal, and then we also have a Federal Reserve decision. So everybody's expecting 50, but what else do they say during the press conference? Would that cause a further sell-off? They're not going to surprise with 75. That would be dramatic. That would take the market just completely down like a rock. If they surprise with anything higher than a 50 basis point raise, that's just going to take the market down like a rock. But I think 2023 is lining up to be kind of pretty nasty. So I have to decide when I want to add positions and what do I want to add. Like, what am I going to add going into 2023? It's going to probably be consumer names. Like, even during a recession, people still have to buy certain things from certain places. So like CVS, Walgreens, Pfizer for medications. I'm still expecting McDonald's to go down, but Kimberly Clark, for example, Procter and Gamble, obviously, just different things that people have to buy that to live, that they just use around the house all the time. Different things like a utility, like AT&T. Probably add some positions there, waiting for that to sell off a little more. They have a lot of debt, that's why they keep getting hit. And then old reliable names like that kind of stuff. So different banks, because people are still going to use banks. JP Morgan, for example, still sitting at just an 11 PE. So CL right here, Colgate Palmolive. There's just different names that you could buy that are kind of recession names. Could we dodge the recession if all of a sudden the Federal Reserve kind of cuts? And no, it just doesn't sound like they're going to do that. It just sounds like they're going to basically ride CPI inflation until it's 2%, and then it's going to shoot clean through 2%, and then it's going to probably go negative by the time that these guys realize how bad they screwed up. We're going to have the exact opposite problem that we're having now, which is harder to fix because by that point, you've already got a bunch of people laid off. Like, they're going to run this economy into the ground. It's very obvious. You can see houses just sitting there. You can see the slowdown. You can see the credit card debt building up with different people. It's just not a very nice scenario right now. So maybe they change their tune in 2023 after they see just a dramatic drop in rents maybe. But, I mean, other people have more faith than I do. I think they're going to ride this thing until it's down. And then you're going to end up having, like, it's just going to be really bad. I just don't. It's just they're going to mess up really bad. That's what they do. So we're going to have to see where they go. Wish it was more positive. Wish there's really not too much positive. I mean, there are places you could put your money in the market. Obviously, as you can see, Procter and Gamble, for example, is up today. You just have to avoid high debt names. for right now. So that's why I haven't added too many positions. I still have dividend reinvesting turned on, but I haven't added any too many positions to T, that type of thing, or Intel, which is getting hit because PC sales are slowing down. Um, there's certainly places to add to, though. I hope that when Walmart reports, it drops by like say 10, 20% or 15%, because this is at a historic high right now. So I expect this probably, if I had to guess, this might back off into the 130s when they say, well, we didn't sell as many TVs as we expected to on Black Friday or something like that. But we'll have to see where that goes. I would love to add back into Walmart, but I'm certainly not adding at 153. There's no chance that's happening. I'll wait till it backs off to 130, or if I get lucky, 121 again. But so if Walmart backs off to 121 again, I might sell some O or something to just free up money to just throw it in there. But I'm building up the cash position, like I said. So by that point, I think I'll have enough. Like I can just throw a whole bunch in there. So that's kind of where we're at right now. Just be very cautious. Um, as you can see, the economic data is kind of coming in. It's kind of coming in slower and slower and slower. This is I just don't see this as being the big crash type thing that people are looking for. It's going to be the slow. It's going to ride these lines, the 200-day moving averages, and this is the dollar down here. It's going to ride the 200-day moving averages, and then it's going to eventually, once it gets to a point that it's low enough, it's going to roll back over and start to go back up again. But that's when the Fed cuts, that type of thing. So, and I don't think they're ever going to cut to zero. They might be forced to this time around again, just to get it to fix the mess up that they're doing. They're doing the exact opposite mess up. Before they were too easy, and then you had government stimulus. Now they're too tight. You don't have no government stimulus. They're really bad at hitting that Goldilocks scenario because they're always relying on lag data. It's really horrible. I hate it. I wish they would change it, but never know. So that's where we're at right now. Just kind of stay cautious with your money. If you're going to invest, make sure you invest in companies that have good profits and are cheap. Don't buy anything expensive right now. So that's my advice. So have a nice day, y'all. Thank you so much.